All right, guys, let's dive into the market forecast for 2022. All right, before we jump into 2022, let's do a little recap of 2021, shall we? Okay, so first off, let's talk about interest rates. The forecast was originally that the expectation was that the rates were going to rise at the beginning of 2021 and recover come time for the fall. However, what did actually happen was the rates rose sharply through March as anticipated, but they recovered a bit earlier than we expected, gaining back most of the losses by late summer. So now when it came to housing, the forecast was, demand was going to be strong and supply was going to be tight. And this would push home prices up high by single digit percentages. However, there was such a strong demand and tight supply. And let's not forget COVID causing all the supply chain disruptions with labor shortages. This pushed real estate values even higher than our robust forecast from last year. Let's take a look at some of the dynamics that are going to truly drive this market in 2022. First off, of course, the Fed. It's no different than how the Fed plays a major role every other year. But this year in particular, they started right at the end of last year in 2021, tapering some of its purchases of mortgage bonds. It's going to continue that tapering. All of this activity by the Fed is going to have a large impact on equity markets, interest rates, as well as it's going to impact housing and jobs. We have to take into account that some Fed voting members rotate each year. There are 19 Fed members in all. 12 of them vote. 4 of them rotate in and out each year. With this rotation, we're thinking that the 2022 composition of the Fed will be less accommodative than 2021 was. Fighting inflation is going to be the main focus of this 2022 Fed. And as we know, the stock market normally does not like inflation having a negative reaction, which could cause the Fed to lose resolve. Taking a look at history can help us forecast how the Fed's actions in 2022 will influence the markets. So let's take a look. Under the Fed chairs around the 70s and 80s, inflation rose from 7% to 14%. Mortgage rates increased from 12 to 18%. They then rose the federal funds rate from 11% to 20%. Inflation responded nicely by declining from 14% down to 5%. Mortgage rates followed suit, going from 18% down to 12%. Consequences? Stock market took a hit by 30%. U.S. was in a recession. So a recap of where we're at now. Jerome Powell, our wonderful Fed chair, the inflation that he thought was transitory has gone from 2% up to 7%. Mortgage rates have gone from 2.5% up to 3.375%. So what we're thinking is going to happen by the end of 2022, the federal funds rate will have risen from 0% up to 1%. Now, what do we know from the past is that this should cause inflation to drop and mortgage rates should also follow suit. How will this affect the stock market? Well, let's be honest. Stocks are expensive and the economy's slowing. So could all of this bring us back into a recession come 2023 or 2024? Now, before you think you know what's going to happen this year or next year, there are a few wild cards I want to throw out. COVID. Have you heard of it? COVID, no matter what we think of it or how we feel about it, it plays a major influence on monetary policy and, well, supply chains, if you haven't noticed. Major surprises in COVID could change outlook dramatically, so keep that in consideration. We don't know, there may be additional stimulus. Now that could fan the flames of inflation. This would also push stock prices temporarily higher and cause mortgage rates to rise further. This could also make the Fed's job of corralling the inflation much more difficult. So going back to that runoff of the Fed's balance sheet, while we already know that this is in the cards for the Feds, we're going to consider this a wild card because let's go through the process. First step, the Feds are going to stop purchasing new mortgage bonds and treasuries. Remember, we're tapering to March. Next step, come May, hopefully not till May, but starting come May, the hiking of the federal funds rate. And remember, we're forecasting that to go from 0% to 1%. Now, the Fed's still buying $70 billion a month in mortgage bonds through reinvestments is what is keeping those rates low. So if and when the Fed stops reinvesting, mortgage rates could move higher than previously thought. Moment we've all been waiting for. Now, let's talk about our forecast for the stock market, interest rates, and housing. Okay? So let's start with the stock market. Now, stocks are expensive, let's just be honest. The price to earning multiples are very high right now. So rate hikes are going to cause those price to earning multiples to contract, resulting in lower stock prices as seen in the past. So the overall forecast for stock markets is that we should be seeing about a 10% decline in the major indices in 2022 for stock markets. Now for your interest rate forecast. So the overall forecast is that during the first half of the year, you're going to see mortgage rates rise up to about 3.75%. Then it's going to decline back down to 3% in the second half of the year as the Feds hike the federal fund rate up toward that 1%. Now, strategically, this sets up a bias for less upfront fees because of a refinance opportunity ahead. Take that into consideration. That doesn't mean don't purchase now. It just means if you find the home of your dreams right now, buy it. We can always refinance in the latter part of the year when the rates go back down. Okay? And last, but certainly not least, what's going to happen with the housing market? Well, housing's going to remain strong in 2022. Not as strong as 2021. I mean, demand might be slightly softer due to a rise in interest rates, but it's still going to be very robust. So for you sellers, the opportunity is there to sell, and for you buyers, the opportunity is there to buy. Now, supply is going to increase a little bit, but it's still going to remain tight. Also affecting housing is the fact that rents are going to rise. We're going to see increases remaining above 5%, pushing many people, and I hope it does, to see the benefit of buying. Because let's be honest, either way you're paying a mortgage. You're either paying someone else's rent or your very own, where you can actually see the advantages. So the forecast overall for housing, we're going to see mid to high single-digit appreciation. But this still is going to provide a great wealth creation opportunity. So don't miss out on it. All right, guys, there you have it, the market forecast of 2022. Thank you so much for watching this video. Please, for my algorithm, go down there and hit the like button. I would appreciate it immensely. This is Carrie Cobb, your B.O.S. mortgage coach, where we coach you how to build opportunities through simple solutions. Also, before you tune out, hit the subscribe button so that you don't miss out on next month's market update. Because every month we're going to be providing a market update so that you stay in tune with the market and make the best decision possible for you and your family. All right, until next time or the next video, your B.O.S. coach.